Okay. So the first thing is first. Where is activity? Let me close this. Okay. So you will be getting work such as what you see on your screen right now. So I'll be explaining the work and I'll be giving it to you guys to do. And I'll be admitting everybody as we go. Okay. So I'm gonna go to book. Let me just admit a few more people. Okay. So the first thing we're going to be talking about is the accounting equation. Okay. So what you're looking at is the accounting equation breaking down. So what the accounting equation would be is your assets is equal to owner's equity plus your liabilities, right? Or it's going to be your owner's equity is equal to your assets minus your liabilities. So I can also put that one down. Assets minus your liabilities. It would also be your liabilities is equal to your assets minus your owner's equity. Whatever way you write your accounting equation is up to you. At the end of the day, the basic premise of the accounting equation is it must always be equal on both sides. So if you look at this example here, you have 10,000 on this side, right? Then you have 10,000 on this side. So minus 10,000 here, minus 10,000 there. You have no liabilities. So on either side of the accounting equation, you have 10,000 Rand or minus 10,000 Rand. And that's the basic premise of the accounting equation, that it must balance on both sides. Okay. So then I broke it down for you here. So you have your assets, your owner's equities, and your liabilities. Okay. So your assets, and you see there's a lot of plus minuses here. So with your assets, let me just hide, no, let me not hide it. With your assets, they increase on the debit side. So this will be your debit side, and you usually see it on your T accounts written as DR. And then your assets decrease on the credit side, and you usually see it as CR, okay? And I mean this for all of your assets. Except of course for your negative asset, like a negative asset is like your accumulated depreciation. But let's not get into that for now. Then your liabilities, they decrease on the debit side and they increase on the credit side, okay? And this is for all your liabilities. And then your owner's equity, your owner's equity decreases on the credit side and it increases on, sorry, it decreases on the debit side, it increases on the credit side. So then you'll see your owner's equity accounts don't increase or decrease on similar sides, right? So you see your capital and your incomes are increasing on your credit side, whereas your drawings and your expenses are increasing on the debit side, okay? And the reason for this is that when your capital and your income, did I kick them out? What's going on here? When your capital and your income increases, it increases your owner's equity. I should rather share my slides so you can always see the board. When your capital and your income increase, they will increase your owner's equity. When your expenses and drawings increase, they will decrease your owner's equity. Give me a moment. Hello? Hello? Okay, guys, give me just I'm going to be sharing. Let's have like, sorry, my mic is here. Let's do a bit. Let's wait a bit. 5 minutes. Let's allow everybody to log in. In the meantime, I'm going to still share my screen with you guys. I wonder why I can't share my Excel. It's weird. Okay, while that is happening, I want you guys to type in your student number or your surname. You can do whichever one, but if you're going to type in your, please retype your name in again. So I have Ali guessed, so I wouldn't know which Ali it is in the case that there is two. Please just type in your name and surname or student number. Then I have an email from iCloud. Dumas, and I'm sorry if I'm butchering this. Sud. I'm not sure. Please type in your student number as well. Okay, so far we have names and surnames. Mamba, I have a Mamba guest. I would also please ask you to type in your surname and name or student number. And that should be all. Thank you so much. Okay, we're gonna continue, and then we'll try to catch up everybody as they enter. Okay, so I'm just gonna repeat for anybody who just joined in. I see there is one extra person. So the structure of the class is going to be such that I'm going to explain the concepts, and then I'll give you like a small example where I explain it, and then you will then do the work, and then we'll mark it, and I'll explain it as I'm marking, and then we'll rinse, repeat, rinse, repeat. Okay. So just to start us off again, the first thing we'll be covering is the accounting equation. So the accounting equation is, as you see over here, you have your assets is equal to owner's equity plus your liabilities. You have your owner's equity is equal to your assets minus your liabilities. And then finally, you have your liabilities is equal to assets minus your owner's equity. So these are not different. These are the same things, just written backwards or from the middle, whatever the case may be. They should always equal. They must always be equal on either side. So if I give you this example here on the side, you will see that your assets have minus 10,000. Your owner's equity is also minus 10,000. You have no liabilities. So you have minus 10,000 on this side, minus 10,000 on this side. Okay. And then under this format, so you have your owner's equity again, remember? 10,000 assets, 10,000, no liabilities, 10,000. Okay. And then over here, your liabilities are sitting at 0. Your owner's equity sitting in minus 10. Your assets also sitting at minus 10. So remember, a minus times a minus will give you a plus. So you have plus 10,000 minus 10,000 will give you 0 on that side, the same as you see on your liabilities. So your accounting equation should always be equal on either side. Okay. Then I have broken down your accounting equation here, up here. So you have your assets, you have your owner's equities, and you have your liabilities. And I just listed the type of accounts that would go in there. And these are just the account headings, the type of account, depending on years. I'll get to that just now. So obviously, this is the debit side and this is the credit side of any accounting. Any account, sorry, any account. And with your assets, they're going to be increasing on the debit side. So that's how you see a plus there on the debit side. And they will be decreasing on the credit side. Okay, so this is for all your assets, except for any negative assets, which you're not going to cover now yet. Your liabilities will be decreasing on the debit side and increasing on the credit side. Give me a moment. Okay, then your owner's equity accounts, you will see that they are increasing on different sides, right? So your capital and your income are increasing on the credit side, and your drawings and expenses are increasing on the debit side. Okay, so the reason for this, when your capital and your incomes increase, they will increase your owner's equity, the worth of the business. And then when your expenses and drawings increase, they will then decrease your owner's equity, which is the worth of the business. Okay, so that's essentially the accounting equation. So if you are ever given a question to say you have, let's say, trading stock or inventory. Inventory is about 3,000. Let's say payables is about 6,000. And then let's say that bank is about 3,000. Okay. So under my assets, I'm going to have the 3,000 from bank plus the 3,000 from inventories. So my assets are sitting there at 6,000. I have no owner's equity, so I'm going to remove that, right? My liabilities are then my liabilities are then 6,000. Let me make it 9,000. Just want to show you something that you're going to have to do. 1,000. Okay, so my liabilities are sitting there at 8,000, right? Now, for this accounting equation to balance, my owner's equity needs to change, right? So you're going to take 8,000 minus your 6,000 over there. So I have my worth of my business being in the negatives, right? So my assets are 6,000, but then my liabilities are 8,000. So my business is worth minus 2,000, right? So we have 8,000 minus 2,000, which will give us 6,000. And then we have 6,000 on this side. So that's just an example. So it must always balance. So if you ever receive a question, which you are in these questions, that it doesn't necessarily balance from the actual transaction or the actual question, then you make it balance. Okay. So I'm going to share the actual activity and then I'm also going to send it to you guys, but I'm going to share it on my screen first, and then you guys can quickly do that. Yes, the class is going to be finished at 6 p.m. So all our classes are 3 hours each. They're 3 hours a piece. So on Wednesdays, we start at 3 o'clock until 6. And then on what is this? On Thursdays, we start at 2 to 5. Okay. So the one I was talking about is going to be a question. So your question 1, this is where you're going to be telling me what type of account it is. Okay. So I'm just going to go back because there's something I didn't tell you. And if I don't tell you now, I'll forget. Okay, so back here. So obviously you're going to be naming accounts over there. So you can use your books if you want. It's fine. I would challenge you not to use your books. We have non-current assets and current assets, non-current liabilities and current liabilities. This is the one thing I forgot to tell you. So your non-current assets, these are assets that you would usually keep for more than 12 months. So these are stuff like your laptop, your laptops in the, if you own a business, the computers, machinery like printers, vehicles, delivery vehicles, your land and your buildings, your furniture, stuff like that. So these are the things, your long-term intangible assets like your fixed deposits and stuff. So these are the things that will last you usually more than 12 months. Then you have your current assets, and these are the assets that are going to be not necessarily lasting you over the 12 months per se. Not that they can't, but usually they last less. They don't last longer than 12 months. So also the other premise is that when can you turn this into actual money? So with your assets, with your current assets, you have your inventory that you want to sell every single day if you could. You have your debtors, your receivables who you want to receive payment as fast as possible in 30 days, in 60 days, whatever the case may be. You have your cash and cash equivalents, which is already cash. So the time also speaks to when can you turn it into cash, and your bank account is already turned into cash already. You can sell your inventories tomorrow and turn it into cash. You won't necessarily sell your vehicles in less than 12 months to turn it into cash. So that'll be the years and how they'll work. Then with your liabilities, your non-current liabilities are your long-term debts, if you may. So this is stuff like if you had a phone contract now and you, let's say we start now in January and you start paying off this 24-month contract. This year, you half of that contract, that will be your current liabilities. That's how the current debt, how much you owe this year. After this year will be your non-current for under your non-current liabilities. So these are the things that are only going to be due after the year. Okay. So I'm gonna give you that work to do now. I'm just gonna mute my mic and I'm just gonna give you that work to do. So you will just tell me what type of they fall under. Is it an asset? Is it an expense? Is it a liability? And I think just for fun's sake, if you could add if it's a non-current asset, and let's see what we come up with. So I'm going to share that activity with you here, and then I'm going to be attaching it to the actual, if Teams will allow me to actually send you the file. I give you about, let me see, this should take you about, let's say 10 minutes. So at 10:02, we'll be marking. Okay, have at it. All right, welcome back. Okay, let's see. So we have purchases. Let me grab my mouse. So much better. Okay. Yes, I did. I just admit somebody in here. Also, I wonder if the settings can just be made so that everybody is just welcome, no matter. Or let colors bypass lobby, yes, actually. Okay. That way I don't have to admit people and they don't have to get stuck waiting to be admitted. Okay, so I'm gonna share my other screen now for the answers. Here are the answers. So for purchases, that's an expense. People are waiting a lot. Hold up. They admitted this one. Okay, while that's admitting. Okay, now it actually doesn't want to admit. Okay, purchases, that's an expense. Sales is an income. Receivables control is a current asset. Your land and buildings is a non-current asset. Your fees earned is an income. Cost of sales is an expense. Depreciation is an drawings received is an income. Investment is an asset. Depending on what type of investment it is. So if you have a fixed deposit that's going to mature after 12 months, then that's a non-current. But if your fixed deposit is due to mature in the next 2 months, then it's a current asset. That's just an example. But usually it's a non-current asset. Your advertising is expense. Services rendered can be an income and it can be an expense depending who's rendering the service. If we render the service, this is an income. If somebody renders the service for us and we have to pay them, it's an expense. Interest on overdraft is an expense. Your inventory is a current asset. Your payables control is a current liability. Coverage on purchases is an expense. Coverage on sales is also an expense. Your vehicles is a non-current asset. Your stationery is an expense along with your sales returns. Your current income is an income. Your cash flow is a current asset. Your furnitures and fittings is a non-current asset. Your credit losses is an expense. Your bank overdraft is a current liability. Insurance is an expense. And your incomes is an income. I mean, your purchases returns an income, sorry. Okay. So I didn't necessarily give you guys a break. We have 4 minutes over your break, actually 5 now. So I'm going to give you a break now. So come back at 5 minutes after 4. That's 6 minutes after 4. Break, so I'm just going to leave the lobby. And then we'll continue. All right, welcome back. So what I'm gonna do now is I'm gonna share the next activity. So this is the one where you're going to be calculating your accounting equation. So let me just share that one. So here it is. So you'll see that you're given motor vehicles for the first one. Okay, it says in each of the following problems, determine the owner's equity, the net worth of the business. So you always have to determine that. So they give you motor vehicles 2,000, land and buildings 5,000, cash in the bank 4,000. For the first one, let me not tell you. Do that. But you see, they give you no liabilities. So then, how much is your owner's equity? So quickly do that. I'm gonna give you guys about 10 minutes to do. No, 15 minutes. 15 minutes. So we'll mark at 15 minutes from now, 17:22. We'll mark at 4:22. Okay, I'll do the first one as an example. You will be using a perpetual inventory system. So whenever you see inventory, um, you will then be using an inventory system. In cases where you see purchases and coverage and purchases returns, then you will use a perpetual inventory system. Okay, so let me share my whole screen because it will be easier to navigate. Let me share my entire desktop. Okay. So there's a question. You have motor vehicles for 2000. I'm just gonna remove it because I think I've already answered this. Just gonna remove it. Make it white. Okay. Then we'll start with this one. This and this and this. I just realized it's actually this one. Right. As well. Okay. Come on. You were told that you have motor vehicles of 2000, which falls under assets. So if I say equals and I say 2000, I have motor vehicles in there, right? The next one I have is land, which is also an asset. So for 5,000, I have land, right? And then I have cash in the bank for 4,000, which is also an asset. So I have 4,000. They make no mention of liabilities, right? So the value of my business is 11,000 minus my liabilities of zero. The value of my business is 11,000 with me. So you will either get this and this or this or yeah, and then you have to calculate your owner's equity. Screen. Otherwise, I'll start flickering around the screens and then you will lose track of where you are. Is that fine? Does everybody get it? Raise your hand if you still don't understand it. Okay. All right. You guys should be done by now. I'm just gonna do the memo and then we're gonna continue. Okay. Let me just share my whole entire desktop. Okay. So the second one there, you have, even though I know it's not, maybe press I. Yeah, that works. So the second one there, you have inventory of 200 rand. So I'm just gonna unselect this, and I'm just gonna undo everything and then redo it. Make it black. Okay. Okay. They say there you have inventory of 200,000, 200 rand. You have motor vehicles of 2,000. You have accounts receivable of 500, and you have accounts payable of 300. So your accounts payable are 300. So I can immediately put that. Remember this. Let me just go here. Remember, whenever you raise the liability, you're going to be crediting whichever account will be whichever liability account you'll be crediting, and that account is going to be increasing. It's only decreasing when you pay off that liability. So when you see me put the 300 there without a minus or whatever, it's because that will be increasing. That liability is going up. Okay. So that liability, and then you have your inventory, so 200 rand. You have your motor vehicles for 2,000 rand, and you have your accounts receivable for 500 rand. Okay, that equates to 2,700, right? So I'm gonna say the 2,700, which is my assets, minus my liabilities, because that's my formula for calculating my owner's equity, right? So my assets minus my liabilities will give me 2,400. So this is what we're going to do for all of them. So I'm just going to make them all black and just remove them. And I'm just going to do that from the beginning. So then the third one, cash in hand, we have 60,000, right? We have furniture for 400. We have inventory on the shelves for 250. We have a loan from KY, which I'm going to skip for now. We have accounts receivables of 200. We have accounts payable, which we're also going to skip. And we have cash in the bank for 320. And so we have 1.230 there. Then our liabilities, these are the things that I skipped. First, the loan from KY. Next is the accounts payable for 150 rand. And my liabilities are 450 rand over there. So again, I'm gonna say assets minus my liabilities, and I'm going to get how much my value is. Before we 4,000, right? And obviously you will send in the active bank account. So I leave that for bigger liabilities. Your vehicles is 3,000. Your accounts payable, I'm gonna skip. Your accounts receivables is 350. Your loan, I'm also gonna skip. So I'm gonna take it as it meant that loan was 2D Brown, because you would have taken it like that. So I'm gonna add 140 there. So that will be a debtor of ours. So we gave him a loan. All right. Then we have equipment, which is 700. So let me just make sure we have inventory for 4,000, vehicles for 3,000, 3.5 for accounts receivables, the loan we gave to D Brown for 140, and the equipment for 700. We have 8,190. And then we have accounts payable. Sorry, bank overdraft first, plus my accounts payable, right? Plus no, nothing. So that loan is 2. So then I'm gonna go again, same thing. In fact, what I'm gonna do is I'm gonna copy this form. So assets minus my liabilities will give me 7,240 is the value of my business. We have furnitures and fittings for 2,000. We have cash in the bank for 600. We have receivables for 500, right? And then we have payables for 300. And the value of our business is 2,800. Okay. Number 6, we have bank overdraft, which I'm going to skip. We have land and buildings for 25,000. We have office machines for 2,000. We have motor vehicles for 12,000, right? So you have 39,000 as the current value of the business. Once I put that liability, that 5,000 for bank overdraft, the value of a business goes down to 34,000. Okay. Number 7, we have mortgage on buildings. Okay, so mortgage on buildings will be the loan, will be like a loan. I want to skip that. We have cash for 1,000. We have loan to employee, so that's 2,000 there. That employee owes us money. We have accounts payable, which I'm going to skip. We have buildings for 12,000. We have accounts receivables for 1,500. Right. Then those liabilities. So we had that mortgage of 8,000. We had accounts payable for 2,000. And that was it. And that's the value for our business there. And then the very last one, we have inventory of 1,500. We have bank overdraft, which I'm gonna skip. We have vehicles for 6,000. We have equipment for 12,000. We have buildings for 24,000. Loan ACE. Okay, so that loan is from ACE. Because not saying 2, and usually it from this person if that's the heading of it. So that's we're going to skip as well. And those are all our assets. And then our liabilities. We have bank overdraft of 800. We have that loan from ACE for 15,000. That's how much we have over there. So that's our number 2. Okay. Then our number 3. Let me just see our number 3. Should be the account equation, yes, using periodic and perpetual, correct. Okay, so our number 3, I'm just going to make this one bigger. I know I explained it somewhere. Yeah. Okay, so here we have the accounting equation. Now I'm going to remove the work in between, but I'm going to leave the questions because this is going to be like an example. Okay, so I'm just going to redo this. I redo this with you guys because I want you to follow, to see where to follow. I know you can see where to follow, but it's just better if I'm just showing you like over here, over there. I don't know, I just find it better. Okay, so the accounting equation is exactly this. So you had the accounting equation over here, and you also had the accounting equation over there. Sorry, let me just add those pluses. So you had the accounting equation over there as well. So you showed me that this account is increasing, this account is increasing, this is how much the value of the business is. Then over here, I showed you the accounting equation that I showed you. So now we're just going to go into in more detail. But I'm also going to be showing you the perpetual side, because as you see, the next question will require you to show me the differences between perpetual and periodic inventory systems. Okay. So the difference between those two is the following. Okay, I see I have done that thing. Okay. We have perpetual. I'll type it here. We have periodic. Maybe let me put it here. The differences is that with perpetual, you have trading inventory and you have cost of sales. You ever asked trading inventory during perpetual? Because we still have to calculate the value of trading inventory at the end in any case. You can also include that, but usually it's not there. So here, usually there is no trading inventory and no cost of sales. We instead have purchases. Whenever we purchase inventory, okay? And then with your perpetual inventory system, all the costs that are incurred to bring the product to a finished product will be added to the cost of sales of that, so the cost price of that product. So if you're paying for the actual purchase price, the delivery fees, so fuel will be included in there, customs, all that stuff will be added in the cost of sales of the product. Once it's now on the shelf and it's a finished product, you stop adding the cost to the cost price, and you add to your other expenses like storage costs, carriage and sales, so delivery to the customer, stuff like that. Okay. Whenever you have a delivery, so it'll always be carriage and purchases. So let me just write it down. It'll be carriage on purchases unless you have delivered the stock to the premises via a train, and then it will be called railage on purchases. So that's the only difference there. Whenever you have a delivery, you still call this inventory because you're increasing inventory. So with perpetual inventory system, we always know how much something costs us at all times. With the periodic, we are only going to calculate the cost of something at the end of the financial year. All right. So if I come back here, I have examples here. So I have that example. Basically, when you see the 1st, the 8th, the 29th, I have just repeated the same thing. I'm just going to show you the differences between the two. Okay, so on the 1st, I'm going to write 1 day. You have, and I don't know, do you want to show? Okay. One thing I also forgot, sorry. In accounting, 2 things I forgot actually. In accounting, number 1, whenever you see a plus here, so you see a plus on the debit side for drawings, for expenses, and all your assets, and then you see a plus for your capital, your incomes, and all your liabilities. That's where you'll find the balances of your accounts, okay? Your bank account can have a negative balance that is called bank overdraft, but for the most part, you'll find the balance of any account in accounting on its increasing side, okay? It's also, let me see, where do I have space to write this down? Let me just take in high school you had the debt click, which meant that you will debit all your expenses, right? You see, all your assets, right? So I'm just gonna actually mark them. You'll debit all your expenses, all your assets, and your drawings, right? What that means is that you will find the balance on the debit side, right? And then you will credit all your liabilities, all your incomes, and all your capital, and your capital. Sorry, I put a K there. There's no K in debt click. Sorry about that. So you'll find the balances of these accounts on the credit side. So let me just remove this K. Debt click like that. Okay. Then the other thing, what you see on the board now, capital, income, drawings, these are accounts, right? So we have accounts in accounting that we use to account for transactions. So to show the increases and decreases in the account, so what I'm saying is to show the movement, we need to draw them in a particular format called a T account. So what a T account will look like, let me see, I had them, yes. It'll look something like this, right? Let's look at our bank account. If you look at our bank account, you see this is a T account, right? It has a debit, it has a credit side, it's an asset. When I ask you, when you look at this and I ask you which of the two contra accounts, well, I mean my contra account, so when you have a transaction, say you bought trading inventory. Trading inventory is bank's contra account, and bank is trading inventory's contra account. What I mean by that is these are the transactions that we use to show the movement of this one amount. So they're the partners in this one transaction. So the two contra accounts here are bank and payables control on this particular T account, the only one. So when I ask you which account is credited with the amount of 10,350 Rand, your answer should be bank, because that is the heading of this T account. So at the very top of this T account, the heading is your bank account. So you will have other random accounts under your bank account that not necessarily your bank account. Now, they're not necessarily the owners of this T account. They have their own T account. So if you look at your payables, here it is up here, and here's the transaction in question over here in green. Okay. So when you're doing whenever you are doing T accounts or the accounting equation or your journals, whatever, always think of these accounts increasing or decreasing, because accounting is essentially going to be the same. So if you're going to debit something in your T account, you're going to debit it under your accounting equation. You're going to debit it in your journals. You're going to debit it in your trial balance. You're going to debit it on your bank statement, your bank sheet, balance sheet or statement of financial position, or your income statement, your statement of profit and loss and other comprehensive income. So it all stems back to a T account, okay? So I want you to ask yourself, whenever you see a transaction, you must always ask yourself, is my bank account decreasing? So if I said that I used, let's take this example, for instance. Obviously here we paid our creditor, right? So we did a check for 10,350 to pay our creditor, or to pay our account that we opened. So if you have an Edgar's account, you paying that off, right? So you must ask yourself, this money, what am I paying with? I'm paying with money, right? Is it coming from another credit? Not necessarily, because you issued a check. So the source document is issued a check. A check is linked to our bank account. So now, if I'm spending money from my bank account is going to decrease, right? So now, on which side does an asset decrease? It decreases on the credit side. So I'm going to credit my bank account with 10,350 Rand, okay? And even if you don't know what you do with the contra account, in accounting, we have what is called the cross-reference rule, which means that you will always debit one account and credit another. So you'll debit one account and you will credit its contra account. So the one that's linked to that transaction. So you'll never see, like, let's say for this transaction, you'll never see me credit my bank account and then also credit my payables control. It doesn't work like that. you will in the test get a mark for the correct one, and you'll get an incorrect for, you'll get a cross for the incorrect one. So you must always know that. Okay, then we come to, so I told you your payables increases on the credit side, right? So now you must ask yourself, my liabilities. So liabilities is debts that you owe, right? This is money that you owe to people that you have to pay. Are my liabilities increasing or decreasing if I pay if I pay 10,000 from them? So what I mean is, let's say I owe 100,000 and I pay 10,000. Do I owe more or less? Do I owe 10,000 more than I did before I paid? Or do I owe 10,000 less than when I paid? And obviously I owe less. So my liabilities are decreasing. So if my liabilities are decreasing, they decrease on the debit side according to my accounting equation. So I will debit my payables control. So the same is going to remain true when we come back to, where is it? When we come back to accounting equation, right? So the first transaction there, it says there, the 1st of Jan, you bought 3 tables for 10,000 Rand for resale purposes from Builders SA and paid by check. Okay, so you bought 3 tables and together they were 10,000 Rand, right? So this could have been furniture, right, from bought 3 tables. But the moment they said for resale purposes, this obviously became inventory. So is my inventory going up? Do I have more tables in my inventory or do I have less? I have more. So I'm going to be debiting my inventory, because remember my assets, they increase on the debit side. So I have inventories going up, right? What did I buy this with? If I look over there, I paid by check, so my bank account is going down. So my bank account is going to be decreasing, right? Then over here, I have 10,000 Rand. Why didn't I make these numbers? I'm surprised I didn't make it a currency. So I have 10,000 Rand in here, right? It's increasing because of inventory. My inventory is going up. Another way, if you didn't understand that inventory is going up, if you look on the debit side, so inventory sits here on the debit side, right? What do you see on the debit side of assets? You see a plus. Hence, I'm going to be putting a plus there, right? And then my bank account is going to be decreasing. If you also didn't know that, on the credit side of your assets is a minus. So that's plus minus 10,000, okay? If we move down here, I am going to copy the 10. No, I'm not gonna copy it, but I want to copy to show you that it's the same. So for the same transaction, using a periodic inventory system. So this is a perpetual inventory system. Now we're gonna be using a periodic inventory. We still have bank, okay? We still have bank being credited. We still have 10,000 Rand that is leaving our bank account. So our assets are decreasing. But now remember, we're going to be debiting an expense account called purchases, right? So purchases is here. Now, I want to make one thing clear. Your purchases account is going to be increasing because it's going to be debited, okay? The only reason you're going to see me put a minus there is because when my expenses increase, they're going to be decreasing my owner's equity. And if you look up here, the account that's sitting here is my owner's equity account. So my owner's equity account is going to be going down, regardless that my expense account is going to be going up, okay? Now, on the 8th, issued a check, so we know that my bank account is sitting here. We know it's being credited, we're losing money, okay? Issued a check for the delivery of the stock bought on the 1st. So my inventory account is also going to be going up in this transaction, because remember, this will add to the cost of sales, right? The cost price of the inventory. Bought on the 1st of January, which cost 2.3. So I have 2,300 here. Inventory is going up by 2,300, and my bank account is going down by 2,300. You can also say your assets are going up by 2.3 and they're going down by 2.3. So this is the zero effect, this is the zero effect, okay? Going up and down. So 0, 0, 0. accounting equation balances. Then we come over here, the eighth. Sorry, let me just write the first there. The eighth. Bank account stays the same. We issued a check still. We still have 2,300 there, and my assets are still decreasing because my bank account is credited. Now, they don't necessarily say what type of delivery it was, if it was a bus, a train, a flight, so we're going to assume carriage and purchases. Carriage and purchases there, which is an expense account as well. So remember, my expense account is going up, but my owner's equity is going to be decreasing. Okay, fine. And then we have the 29th, right? And I see there's 2 minutes to your break. I see it. Received a duplicate receipt. Okay, so I received a duplicate receipt. So I received money into my bank account for the stock bought on the 1st of Jan from Mr. Thomas. Okay, we sold the stock for 20,000. Okay, so we made a sale. So now I must enter my account, right? Coming into my bank account, and the reason for this, the contra account for this is going to be my sales account. I made an income, so I put my income in my bank account. That's where I received it. Using a perpetual inventory system, whenever you make a sale, you have to show the cost of making that sale, right? So now my account's debited. That's going to be my cost of sales, but I'll start with my trading inventory. We have trading inventory. Let me just see what format did I use for this. Very important, actually. Okay, that's fine. We'll change it up later. So I'm going to start with inventory. If you sell something, so we sit here with 12,300 worth of inventory, but I'm selling it, right? So now I have to decrease my inventory account because I don't have this inventory anymore. So I must remove it from my books. So to remove it, I put it on the opposite side, my credit side, right? I'm going to put that inventory there. I'm going to say 12,300 worth of inventory is being subtracted from my books, right? So this inventory here, I'm de-recognizing it, okay? And then whenever you remove inventory from your inventory account because you made a sale, you must recognize it as cost of sales. This account, right? So my cost of sales will be going up, but my owner's equity will be going down because of that expense. Now, whenever you have your periodic inventory system, you are just going to do the top line. You're not going to do the bottom line because you don't have cost of sales or inventory. So the transaction will look like this. That's the transaction. So you're going to debit your bank account, 20,000. You're going to credit your sales account, 20,000. So that's what changes. Okay. So now I'm going to share only no, I'm not going to share anything. Well, I'll share this. I'll share this for you, but you're going to go on your break now. You're going to come back at 5:01. So, where am I typing? Break until... Then when you come back from your break, we'll mark it. I mean, sorry, I will give you the activity for you to do, and then we'll mark. And then I'll give you time, and then we'll mark. Before you guys see is my so we have two we have some markup quite late into you have your markup selling price of gross margin. Okay, just if I have it drawing up a lot of things. No, it doesn't seem to be. Okay, I'm not gonna open another file. I probably have it in another file, but I know the piece will take forever. Okay, so you have yeah, have markup, which I'll usually write as mu, or it's markup or called markup. So the formula for markup. Oh yeah, current formulas in here. Markup. I'm gonna write it in here somewhere. And how you do it now? No, you're gonna increase this. So it increases. You do table out the cost. So the formula for markup. Formula. We will write it at the bottom here. So the formula will be markup is equal to my profit over my cost price. Let me just get the fraction. It's equal to profit over cost price. Yes. If they don't give you markup, but they give you, say, your selling price and your either cost price or your profit, you can calculate the market. You can do so. How you build this table? It looks something like this. You have cost price. You have cost price. Just a weird way to write it. I'm used to writing this on the board. You have cost price, you have markup, and you have selling price. Okay. One thing I do want to say is that your markup is equal to your profit. So your markup or gross margin is my all button. Your gross margin percentages so let me just make that a percentage. So this is equal to your profit. When I say your profit, I mean your rand value. So your profit in rands. So these are basically going to be your percentage representation of the actual amounts that you're going to deal with and calculate. So if you think about it, you have and your price is 100%, which and the selling price, let's say that's 150. Markup is 50. So you're 50 the 150 or to save that. You get what I'm saying? But let me make it like more. When your markup is based on your cost price will always be 100%, okay? Because it's based on your cost price. So another example I'd give you is if you got for paper, you make this 50% is going to be based on 60 marks. So if you had 60, you would get 100%, okay? So now this is the same premise. Your markup is based on cost. If you have cost price that's 100, then they will give you different ranking of markup. I use 50 as my markup, or let's use 25. So then you utilize this thing. You have your amount multiplied by what you want over what you have. What did I mean? That one.
Sorry, sir. We cannot see what you are doing at the moment.
Yes, sir. Can't you see the word document?
No.
Raise your hand if you can't see what I'm doing. What are you seeing on the screen?
All the icons are available on the screen only for each learner.
Can't see. That is weird. Okay, I'm going to reshare my screen and see if that helps. Let me share my entire desktop. Screen? Raise your hand to see my screen. I don't know if you hand up the button or not. Can you guys see my share these hands up with one or? Okay, I hope you can. If you can't, you can type it in the box or you can speak. The choice is yours. Okay. I'm just gonna share it this way. Okay. So I have all these things that I put here, and I just put the formula on this side. I should actually attach this formula. But anyway, my formula for markup is as you see on the screen. It's this. Can I take this and paste it in Excel actually? Ah, beautiful. Love it. Okay, I'm gonna work here. So my formula for markup is what you see over here, right? This is the formula. Put it there. Then I can build this table. Cost price, markup, 75. So, like I said, your markup is always going to be based on cost price. Your cost price is going to be 100%. So the example I made for green.
Sorry, sir.
And this 50% is going to be based on. So if you got 60 out of 60, then you would have 100. So if you have cost price, then you have 100%. So if you have cost price over cost price, is what I'm saying. Your markup will be whatever they give you. Like, yes, you can speak.
We still can't see what you are doing, sir.
Okay, let me see. I have no idea why you can't see. It could be like a network issue. Can I just get feedback from everybody else with a raise of hands if you can see what I'm doing? Because then in that case, what I would do is share the recording, at least. Okay, other people seem one person can see. Okay, I think what's happening is that you're having like a network thing. I may also be having a network thing, but it's the network. So I have shared my whole entire screen at the moment. So what I will do, so whenever you can't see my screen, don't stress. What I'll do is I'll share the recording, and the recording will always have the screen because it's gonna be showing it from my perspective. Is that fine? You can do a thumbs up if it's fine. You can do that like thing if that's fine. It's definitely a delay over here. Okay. So I'm just gonna share the recording with you guys because it's definitely a delay. I don't know if it's affecting everybody or just the one person. But I will share that recording with you so that whenever it affected you or not, you at least can go watch back. Okay, so now when you build your table, and I'm gonna voice out everything I'm gonna say now, you have your table, your heading is going to be your markup or markup on cost price, right? Your then underneath is going to be cost price, markup, and selling price. Okay. On your cost price, you're gonna write 100. On your markup, you're gonna write whatever they give you. So I'm gonna write 25% on markup. So my cost price is 100%, my markup is 25%, and my selling price is 125%. Because my selling price is always going to be the sum of my markup and my cost price, right? So this is how I'm gonna build that formula. Then I'm going to take a formula that I've already written, or some of it. Let me copy this. I was in that copying now. So I have my amount multiplied by what I want divided by what I have that I'm also going to put here. Okay. So now I want to use markup. So I have markup right now. I want to use it, right? So I have my 100 for cost price, my markup is 25, and my selling price is 125. Let's make a random amount. We have 10,000. Let's say we have 10,000. Okay. Let me put it equals here actually. Oh no, actually let me not. We have 10,000. Now I'm gonna multiply this by what I want. Let's say what I'm looking for is going to be this is why I wanted to put it equals. Let's say what I want, and I'm gonna put it equals now. What I want is that 25%. I want to calculate how much profit I'm gonna make out of this cost price based on my my markup. So I'm going to say 10,000 multiplied by 25. You don't have to write percentages for any of these because the percentages will cancel each other out. Just write them as actual amounts. So I'm going to say 10,000 multiplied by 25 over what I have, right? Because the amount is 10,000. It represents my cost price, right? What I want is the profit. That's why I'm calculating 25%. What I have is my cost price, which is 100%. So I have 10,000 multiplied by 25% over 100%. Or like I said, just write 10,000 multiplied by 25 over 100. You get 2,500, okay? And the reason I wanted to write it down here on the side is because of what you see now. You just see the amount. So 10,000, cut this and paste it here. Okay. So 10,000 multiplied by 25 over 125. Sorry, over 100. That's how you would calculate your cost price if you wanted to calculate your selling price from either the 10,000 or the 25, so if we calculate it from the 10,000, you would say I want 125, right? So 10,000 multiplied by 125 divided by 100, I get 12,500. That's how you would calculate markup, right? So obviously, if you want your selling price from your profit, you would just divide the 25. So 125 divided by 25. That's how you would use that amount multiplied by what you want over what you have. Okay. Then you have something called gross margin or markup on selling price. Okay. I want to see, because I see we're going to run out of time. We're not going to finish all of this. Ledgers, another AOL. Okay, that's fine. So gross margin or markup on selling price. So again, we have the same stuff. We have your cost price, your selling price, and your markup underneath it, right? The formula for this, I'm gonna write it in here because I see I can only quote but not change. So your formula for your gross margin is profit over selling price. So your markup is based on your selling price. What that means is that when you're building your table, your selling price will be 100% this time around. Your markup will be whatever they give you, and your cost price will be the difference. Okay. I'm going to calculate my gross margin. I want to show you that you can calculate your gross margin. Okay. I have my figures here, right? You can calculate your gross margin by using amounts. Remember, I told you you can take your rand value profit over your selling price. So I can say I have my profit here, I have my selling price here, my cost is 10,000. I can say equals 2,500, which is my profit, divided by 12,500, which is my selling price, multiplied by 100%. I forgot that part in the calculations of markup. You multiply this by 100%. Sorry about that. Let me just add. Where is my equation designs? Multiply by 100%. I'm just going to copy that. No, not the whole thing. Come on, not the whole thing. There we go. Okay. I'm going to change this one as well. Just want to show you before. Okay, let me just change it and get it over and done with. Price. Okay, so the answer for that is 20, and that's not just 20 because remember I multiplied by 100, so it's 20%. So I have 20% as my gross margin, and I have 100 minus 20 will give me 80. Remember, my cost price and markup must always give my selling price, right? So my cost price is 80, my markup is 20. 80 plus 20 will give me 100% for my selling price. I could have also used, instead of using actual rand values, I could have used the percentages that you see over here. So I'll show you now. Let me just take this little thing. What did I do now? Let's see. And I'm going to paste it here. Excel sometimes equals. Then I'm going to paste it over here. Then I can just drag this and paste it there as the answer. Okay. Another way I could have done this is to say, I'm going to take my actual markup, right? So 25 divided by the 125 multiplied by 100, and I would get the same 20. So let me show you. So I have 25 divided by 125 multiply by 100, I get the same 20. So you take percentages or you take the random amounts, you will still get your gross margin, right? And you can also go back, so you can also take these percentages to calculate that markup, or you can take these numbers to calculate that markup. You can go back, and obviously you'll be using this formula here for markup that I see I left named as gross margin. Okay, so that's what you do with your markup. So you'll be given your cost price or your selling price, and you need to calculate the other one. And the amount, and the formula you're going to use is the one where you take the amount, you're going to multiply by what you want over what you have. But first, you must already have this this table. So you must already have your markup. Okay, I'm going to give you your next activity. I want you to do, let me see. Let me unshare the whole screen and just share the one thing. I want you to do the next one. So here's the next one here. Number 3 is the next one, right? And then number 4 is going to be the one following that. And then number 5 is coming after. So what I'm going to do is I'm going to do a session where I explain the memo of these. I want you to do all of this. And then what I'm going to do is I'm just gonna record a session where I'm doing corrections of it if I don't do it in our class tomorrow. I'll probably do it in our class tomorrow. Okay, so here's your next one. It says draw the following columns: accounts debited, accounts credited. Owner's equities is equal to assets is equal to owner's equities plus that. Complete by analyzing the following transactions. Where appropriate, show the answer for the periodic inventory system and then for the perpetual inventory system. Your markup is on cost price. You don't have to calculate markup. You already have it. You can just use it. And then you have your list of transactions there. So what you do then, wherever you have a sale or anything that is affected by what is this? Whether it's periodic or perpetual. I want you to show me. So let's say transaction number 7, paid rent. Let's say that was affected by that, which is not. You would then show me. You will then write periodic or perpetual, and then you'll show me how you'll transact it, and then you'll write perpetual. So what I mean. Let me just show you. I'm going to show you briefly because this is the answer. So I want you to come there with a fresh mind and not necessarily that already knows the answer. Okay. Where is it now? Okay, I didn't show it like that. I showed it another way. But you can show it one underneath the other. So you can have something like how we had here, and then you can say, you can have an extra column and you write perpetual, or you can write it at the end here, and then you can show me this transaction and this transaction following each other. I'm going to reshare the question now. I give you the next 15 minutes to complete this one, which will be all the way until 20 minutes to. There's activity now. Have at it.
Sorry, sir, I can't see the question. It's just I can just see your symbol. Now it's loaded in.
Sorry, what are you seeing?
It loaded in now. I see question 3.
Okay. Oh, so you can see it now. Okay. 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 All right, it's time. Okay, so I'm just gonna do it like this. That seems to work quite beautifully. Maybe I'll just decrease this one a bit. Okay, so here we are. So the first one, it says there, the owner contributes cash of 100,000. So we are going to be debiting, and the only reason I'm showing you like this is because I'm looking at the time now, it's almost time. So we're going to be debiting our bank account because, okay, first we're going to credit our capital, right? That's the source of the funds. So our capital is going to be credited. Remember the accounting equation, your capital is credited. And of course, I can see my liabilities do that. So my capital will be credited, which will increase my owner's equity by 100,000. This money will go into my bank account, and my bank account will be debited, which will increase my assets by 100,000 as well. Then on the 7th, we paid rent for 10,000. Make sure my audio. Yes, it is. So on the 7th, we paid rent for 10,000. Okay, so our bank account must now be credited because it must decrease 10,000. Sorry, 10,000 here under assets. And then my rent expense is going to increase, but it's going to decrease my owner's equity. All right. Then on the 11th, purchase motor vehicles for 40,000 cash. So obviously my bank account will be going down with 40,000, and then my vehicles will be going up with 40,000. So I have plus minus 40,000 under vehicles debited, bank is credited. On the 13th, purchased inventory for 30,000 for cash. Okay, so now we're gonna show the differences, and I have no idea where I put the differences now, but anyway, we'll find them. We'll find them. Okay, inventory is being okay. Let's start with inventory. My bank account is gonna go down with 30,000, and then my inventory is going to go up by 30,000. I don't seem to have. Yeah, I don't have it. So I'm gonna add it. So then what you would have done for perpetual, you would have had purchases here. I have no idea why I don't have that here. Purchases, and then you'd still have bank here. And 1,000 for bank, that's a minus. And then you would have minus 30,000 under your owner's equity. Maybe I'll make perpetual like red so you can see that it's different. Okay. Then on the 14th, we have a loan from ABC Finance for 10,000, right? So we received the loan, so we're gonna get money. So first we must raise our liability, right? 10,000, that's a plus. Raise that liability bank loan, and then we receive the money, we debit our bank account. Our assets will be increasing by 10,000. Okay, we'll pay this money at a later stage, but not now. Then we have sales and credit to T Clark for 2,200. So we have the account receivables because my sales on credit, so we didn't actually receive money. So in these types of scenarios, if you think about it, it's like when one supplier buys from another supplier and says, I'll pay you back in 30 days. So they take the stock now. So then they owe them the money within 30 days or 60 days, whatever the credit terms were. And so now in this regard, we sold to said supplier, and the supplier will pay us in 30 days or whatever our credit terms are. So we raise that receivables, saying that we expect to receive this money, but in life sometimes people don't pay you back and you have to write them off. Okay. Nonetheless, we're going to increase our income account. So we're going to increase sales. You're going to credit that with 2,200, increasing our owner's equity. And then our accounts receivable will increase our our assets by 2,000. Then we must show that, first of all, this inventory must leave our inventory books, right? So you credit inventory. We must show the cost of making this sale. So you're going to debit our cost of sales. Now we need to calculate this amount, right? Did I calculate? No, I didn't. Okay, here we are. I have no idea. Oh, over here. So we have 2,200. Okay, let's start here. Our markup is 40%, right? And it's on cost. So markup on cost price up here. Cost price is 100%, like I said. Markup is 40%. Selling price is 140%. Then I have the formula there. Amount multiplied by what I want over what I have, right? My amount, if you look over here, and undo this, my amount is 2,200 and 2,200. What I want is my cost price, which is the 100. So I'm going to select the 100 here. What I have is my selling price, the 140. So I'm going to select that over there. And I have 1,571, so 1,571 Rand and 43 cents. Okay. So that's the amount I have here. So I just rounded it up and I put it there and I put it there. And that's my cost of sales. Okay, 4 minutes. Then, Then using a periodic inventory system, I just have my top line, my accounts receivables, my sales, the 2.2, and that's it. So that will be my periodic. I wrote it at the back here, but you can't see it. I wrote it there, but you can't see it. Then we purchased inventory on credit from Penfolds for 5,000. So I'll show you perpetual. So our accounts payables, we're going to raise that liability, will be credited with 5,000 Rand, increasing our liability. And then we have inventory increasing 5,000 over there. Hold up, let me see something. There could be a reason I didn't add the other stuff. What does it say up here? Perpetual the answer periodic and inventory. Nope, it doesn't say, it just show the sales amounts. I thought that's why maybe I didn't put it in there. Okay, so when I add this, so again, accounts payable stays with that 5,000 over there. That stays the same. What changes is that this 5,000 will be coming here instead, right? And it's going to be raising that expense account. So I'm just going to remove that. I'm going to put a minus. I have courage. Nope, this is not for deliveries. I have purchases again. So accounts payable is being raised, and my purchases is also being raised, but decreasing my owner's equity. 2 minutes. Then we have cash sales of 10,000, and they actually give us the cost price. So we have bank because now we actually receive cash. So my sales is credited, my bank is debited. 10,000 assets increases, 10,000 owner's equity increases. I then have to decrease my inventory account and then increase my cost of sales. So debit cost of sales, credit inventories, 5,000 minus 5,000 minus 5,000 under assets and owner's equity. And then again, remember, your periodic inventory system is just your top line. So it doesn't involve cost of sales or inventory. Okay, 1 minute. Then on the 21st, we have sales on credit to a Perry. Wow, okay. For 3,000 cost price is that. So same as the one on the 17th, no? On the 15th, account receivables is debited, sales is credited, 3,000 under assets going up, 3,000 under owner's equity going up, and then inventory credited, cost of sales debited 1,500 on under each respectful account as a negative effect. And then obviously periodic will then be just a and the last one The owner draws cash for personal use, 500 Rand. What you're going to do is you're going to first remove the money from our bank account. So we're going to credit our bank and debit our drawings. Our drawings is increasing, but our owner's equity is decreasing. Remember, drawings and expenses, when they increase, owner's decrease. Minus 5,000 there, 500 there. Let's go. So minus 5. Okay. What I'm going to do, I'm going to send you this. So you only have question 4, which is this, doing the T accounts for periodic and perpetual. And then you have the accounting equation again. So this is your homework, if you may. Do this for me, and then tomorrow I'm gonna mark it. So I'm gonna explain how it was supposed to be done, and you'll see how you got it right. And then we'll see each other tomorrow at 2 o'clock. So I'm gonna send it to you guys now on your VC Connect email addresses. In fact, I'm opening my emails now to send it to you guys. But thank you so much for joining in this session. If you do have if you have no questions, the session is over. You may enjoy your evening. You may leave the session. Thank you so much. No questions? Thank you so much, guys. I'll see you tomorrow at 2 o'clock.